So as many of you know, BlackRock is the absolute largest asset management company in the entire world at over $10 trillion of assets under management. That's more than half the GDP of the entire European Union, which is just mind-blowing to think about. And it's led, of course, by the infamous CEO Larry Fink. Now, a lot of people have personal feelings on BlackRock, either good or bad, but regardless of that, this is clearly a company here that has one of the largest influences on the world economy and, of course, also the stock market. And so I think it's a very important firm to be keeping track of as stock market investors. Well, it just so happens that their most recent transactions from the last quarter were just released to the public. And so in today's video, we're going to be taking a look at the top 5 largest stock purchases that they made among them. And in typical All Is World fashion, I'll of course give you my own quick opinion on each of these stocks too, and I'll even rank them from best to worst based on that opinion as well. So it's going to be a ton of fun. I can't wait to give you a deeper look here into what BlackRock is up to, what stocks they're buying. Just want to say though, if you are enjoying the channel, if you do enjoy this video, you want to support me, it means so much. It really helps keep this channel alive. You can really do so by hitting the join button here on YouTube, or you can head over to Patreon, link is in the description, and you can also get access to some cool perks like our exclusive channel Discord, where we get to hang out and talk with like-minded investors every day. I'm trying to grow it out as much as possible. It's a ton of fun, and I really hope to see you on there soon. But thanks again for any support you give me at all. It means so much to me, and like I said, it really helps keep this channel alive, so thank you for that. But with all of that said, let's go ahead and jump into this list of 5 largest stocks that BlackRock is buying here. All right, now we'll be counting down here from smallest to largest in the portfolio, and stock number 5 is actually a stock that I've often thought about buying myself in the cybersecurity specialist Palo Alto Networks, ticker symbol PANW, which BlackRock increased their position on by a massive 30% in the second quarter, bringing their total stake in the company up to over $5 billion. Now, Palo Alto is a very interesting stock here, after only being founded in 2005, yet having already grown into the largest market share leader among its peers, with most of them even doing less than half their revenues. Very impressive. And that's because Palo has done a great job of not only offering all the cybersecurity services needed, but by also implementing AI into their platform, which they've been able to use amazing machine learning capabilities from to automate the detection of online threats much faster and more efficiently than a human counterpart ever could, which is a very attractive proposition to big businesses that are trying to run more efficiently and securely. On top of that, they also use a unique multi-platform strategy consisting of Prisma, Cortex, Strata, and Unit that together give customers more choice and simplicity over their own platform security. And that flexibility and robust offering is yet another reason why more customers choose to partner with Palo. In fact, customers can choose any cloud provider they want, like Amazon, Microsoft, Google, Oracle, Alibaba, or any other, and Palo will secure all of it. And yet, despite being the market leader, Palo actually trades the cheapest amongst its peers, with only Zscaler being a very slight exception at a 1.4 PEG ratio versus a 1.3 PEG for Palo Alto. But even then, Zscaler has actually been losing more and more money every year, which is an attribute that really most of these companies share, as they continue to bleed larger amounts of money every year, while Palo, on the other hand, not only continues to put up huge revenue growth rates, but their losses actually improved to just a very slight loss last year, which improved even further to a positive EPS in each of the past 4 quarters in a row. So that's technically a full year of profitability already, and it continues to get better. And that's probably another reason why the stock currently trades considerably cheaper than the average analyst price target, who thinks it should be much higher given the impressive performance. Unfortunately for me though, the stock has already ran up over 50% this year and is still trading somewhat close to an all-time high, which is really the only reason why I've been a little hesitant to jump in, as I continue to buy other stocks that I think look a little cheaper to me. But considering that cybersecurity should be a market worth trillions in the future, I can definitely understand why BlackRock is betting heavy on arguably the biggest or maybe the best player within it. And I'll probably be buying some of the stock myself soon too, because I do really like it, especially if it gets on a considerable dip. But for now, I am ranking it pretty high here at number 2 until I see what else is on this list. All right, moving on to stock number 4 though, we've got the oil and gas giant ConocoPhillips, ticker symbol COP, which BlackRock grew their position on by almost 10% last quarter, adding close to 9 million more shares, bringing their total stake in the company up to over $10 billion. By the way, even at that gigantic size, it's still only worth less than 0.3% of the overall portfolio. So just shows you how massively large BlackRock is. Anyway, Conoco is very well known in the oil and gas industry for being a world leader in exploration and production, what we typically refer to as an E&P type of company in the oil and gas world. However, don't get them confused for the Phillips 66 gas stations that you probably see driving around. Those used to belong to ConocoPhillips, but that sub-brand actually got spun off many years ago, and it now trades on the stock market under its own ticker symbol called PSX. Instead though, COP focuses primarily on production, and the stock is just as cyclical or volatile as you would expect in the oil and gas sector, sometimes crashing, sometimes soaring, but mostly just heavily dependent on how oil prices are doing in the broader economy. All along the way though, you do get to collect a pretty attractive dividend, as is the case with really most oil stocks out there. And in the case of COP specifically, they do happen to pay a double dividend that is a combination of an ordinary dividend as well as a variable dividend, which is dependent on company performance. It's kind of a rare thing here, but right now the variable dividend payout is pretty close to the ordinary dividend, so I usually just double the yield if I'm trying to figure out where it's at. And so right now their regular yield is close to 2%. If we double that, you're probably getting something closer to 4%, which is definitely, a solid yield. However, I've never really had much interest in oil and gas stocks as they're a bit too volatile for me, and I hate having to try and predict where oil prices are going in the short to medium term. So I really just stick with more reliable long-term dividend stocks instead. Plus, even if I was to look at just the business and the stock price appreciation alone, I still think that I'd rather invest in a more pure play renewable energy stock anyway that likely carries more future growth potential. So while I can understand why other people want to own this one, including BlackRock, I just have no personal interest in it myself, and therefore it is going to go in last place for now at number 5, ranking number 5. Okay, moving on to stock number 3 though, I'm actually very happy to see a stock here that I already own myself, because regardless of how big and controversial BlackRock is, I definitely still want them investing in my stocks. And in this particular case, that stock happens to be Broadcom, ticker symbol AVGO, which they added another 1.8 million new shares of, bringing their total stake in the company up to over $27 billion. And even that is still less than 1% of the portfolio, which is pretty crazy. Anyway, I love this pickup here, especially since it's leading up to Broadcom's planned acquisition of VMware, which I think will probably propel the stock even higher once it closes, and that's despite it already trading near an all-time high. But regardless, this is an excellent company with very strong financials, and in my opinion, probably has the most diversified business within the semiconductor industry, as they develop custom chips for businesses that rely on them for storage, internet connectivity, and a variety of other needs. Plus, the VMware acquisition will push them even further into software and services, especially in cloud infrastructure with apps, services, networking, and especially cybersecurity. So you add all of that up with the small but very high growth dividend of a 2.2% yield, but has a low payout ratio and a giant growth rate above 23% and a double-digit growth history, not to mention the cheaper valuation than the sector, especially on a PEG basis. And I think this stock here is actually a very solid pickup right now. And because they have some exposure to cybersecurity, but are also more diversified past just that alone, I'm actually going to go ahead and rank them even higher than Palo Alto at number 1. They easily get the top spot from me. I do like this one. Oh, you know what though, guys? There's another stock here that might actually be threatening Broadcom's top rank, because at stock number 2 here, we've got the almighty Tesla, ticker symbol TSLA, at just over 2% of the portfolio after having added another 7.2 million more shares, bringing their total stake in the company up to over $48 billion. And yeah, this one is definitely going to give Broadcom a run for its money, since not only is the stock price still down close to half its entire value from the top, but business-wise, Tesla has actually been on fire lately, with sales and profits skyrocketing every year, and yet sales are still growing north of 20% expected in each of the next 2 years as well, despite what is really supposed to be a horrendous macro environment for auto sales given the weak economy. I mean, just look at legacy competitors like Ford and GM, who are barely expected to grow next year, pretty much flat, while Tesla is still projected to grow by almost 30%, so it's not even close. The drawback, of course, is that you do have to pay for that growth, as Tesla stock is much more expensive, trading at more than double the PEG ratio of the sector median, which is why I really don't buy any more shares myself, as it's already my second largest stock in my portfolio, so I don't really see any reason to add more shares at this valuation. However, I am still holding the stock very long term, because I just see so much potential in everything they do. The electric vehicle market, for example, has already surpassed over $1 trillion in sales after skyrocketing by over 50% last year. And it's really still in its infancy. So I think this is going to be an extremely large market here that Tesla, obviously caters to with sedans, SUVs, and now it's going to be trucks too, and even the semi for commercial use, which, by the way, logistics is another market that is already worth trillions of dollars as well. And it doesn't even stop there. I mean, autonomous driving will also be worth trillions of dollars, which Tesla, in my opinion, is easily ahead of all the competition on. And even robotics is expected to be worth trillions in the future too, which they'll market to, of course, with the new Tesla bot. Not to mention solar and battery storage, where Tesla also commands a strong leadership there too. And you really just add up all these different things with all the work that they also do in AI with their Dojo supercomputer platform, and the fact that they even make their own AI chips too. And I just think Tesla will likely be either dominating or at least competing very heavily in several gigantic markets of the future. And that's something to be very optimistic about, in my opinion. It's very hard to pick one over the other here compared to Broadcom at today's prices, but I think I'll just give Tesla the slight edge for now and push Broadcom and Palo Alto down one spot so I can fit Tesla in at that #1 ranking. Who knows how long that'll last though, because the final stock on the list is actually the biggest of all by market cap, and that is the giant behemoth Apple, ticker symbol AAPL, which BlackRock bought another close to 5 million more shares of, bringing their total stake in the company up to over $200 billion at over 5% of the portfolio. And by the way, if you missed last quarter's update, Apple was actually the most purchased stock there too. So this now marks 2 quarters in a row that BlackRock has purchased more Apple stock than any other stock in the market. And considering that it was rising all year long with only a small dip this past month, my guess is that BlackRock couldn't even care less what the valuation is or how expensive it's gone. They'll probably keep buying it regardless. I mean, keep in mind, guys, that Apple is technically the most expensive stock in the entire world by market cap at over $2.7 trillion. Now, that's not a knock on them. I actually own Apple stock myself, and while my cost basis is much lower than where the stock is trading today, I still have no plans whatsoever of ever selling any of my shares. I'm really going to be holding on to them as long as I can. And that's because Apple is a fantastically large company with one of the stickiest businesses in the world, doing close to 400 billion in sales, with 100 billion of it going straight to the bottom line just last year alone. Guys, that's $100 billion of profits every single year. That's unbelievable. And mind you, Apple is actually in a very similar situation here that Tesla is in, where the macro environment is supposed to be horrendous, as analysts are projecting that 2023 may be the worst performing year for global smartphone smartphone sales in over a decade in terms of performance. And yet they actually think that Apple might become the market share leader for the first time in the company's history, finally overtaking Samsung for the first time ever. And that's because customers that give Apple a try really tend to stay within the ecosystem of various Apple products like the phone, the tablet, the smartwatch, the laptop, the computer, the TV dongle, so on and so forth. And because of that, they also get entrenched within the various apps and services, which, by the way, despite iPhone sales slightly declining in the most recent quarter, Apple was still able to grow their profits by 5% thanks to those growing services that not only carry huge margins, but also reached a new record high at over 1 billion paid subscriptions. That's gigantic. So, really just imagine how much better they'd be doing in a bull market for smartphones, and especially when they launch maybe a folding or flipping iPhone that I think could trigger the next major upgrade cycle. In the meantime though, Apple gets to use these massive profits to buy back more of their own stock than virtually any other company out there, while also paying a small but high growth potential dividend. And they continue to build up their massive balance sheet, which can be tapped into later for investing in new growth opportunities. But like I said, I'm not really looking to pick up any more shares at today's really high prices. I like to buy my stocks when they're going down, not so much when it's literally the most expensive stock in the entire world by market cap. So it's a little tough to grade here, but I think I'll give Tesla the edge once again because of how much more aggressive and innovative they've been lately. And actually, I'm even going to give Broadcom the edge as well, since they too have been more aggressive. And on top of that, they also have a much cheaper valuation. Apple is like 60% more expensive than the sector on a PEG ratio basis, while Broadcom is actually cheaper by almost 20%. So that'll leave us with our final ranking here. I put Tesla at number 1 for the all-around growth and innovation, Broadcom at number 2 for many of the same qualities as Tesla plus an affordable valuation, Apple at number 3 for being the reliable, gigantic behemoth that they are. Really, anyone can't really go wrong with that one. Palo Alto at number 4 by default because I actually think that they're a very attractive stock too. They just kind of got put in at number 4 by default. And then ConocoPhillips at number 5, which in my opinion is the clear worst choice of the list. But yeah, overall, I would say that I really like these pickups here by BlackRock. I'm not a big fan of the last stock, of course, but stocks 1 to 4 I think are exceptional, and I could really see them being a great fit in pretty much anyone's stock portfolio. So I agree with those pickups, but what do you all think? Do you agree with my ranking here? Would you make any changes? Let me know. And is there any other big, hedge fund or famous investor that you'd like me to take a look at what they're buying or selling? Let me know that down in the comment section too, and I can make those videos for you. But thanks again for stopping by, my friends. Thank you for all the support. I really appreciate it so much. And I will catch you in the next video. Hope you're all doing well. Take care. Bye-bye.